Hello students, my name is Thamisi Melani. I'm a lecturer at GS College, Perdekop campus. I will be taking you through topic 3, Finance, Mathematical Literacy, Level 4. The learning outcome for this topic is that by the end of this lesson, you should be able to understand the financial concept related to business environment. In other words, you should be understanding at the end of this lesson what the net income is. You should also be understanding at the end of this lesson what the taxable income is, the tax rates, tax bracket, the pay, which is known as also pay as you earn, as well as the UIF. But before we begin, it is better if we start with the vocabulary so that we know as we are going on some of the terms that we'll be touching on during this lesson. What I want to talk about here on the vocabulary is the issue of the income. And income is defined as the amount of money a person or a business receives. And then we also have the gross salary. The gross salary is the total income received before any deductions are made. And then the deductions that we are actually talking about in this case, we are talking about the amount that is taken off the gross income before the income is actually deposited to the person's account by the employer. The deduction will be including maybe the UIF, the pay, which is what we are going to talk about, and also the medical contribution and other deductions that maybe the employer or the employee has agreed upon. Now, if you move forward, we have one of the financial documents here that is actually given to the employer by the employee, which is known as a payslip. If you take a note or you take a look at the payslip here, you can see very clearly that on the payslip, we must have the details of the employee, the details such as the name of the employee, the ID number of the employee, the bank account and the bank where the amount is going to be deposited or the income is going to be deposited. Also, when you look on the right side of the salary advice or the payslip, you can see that there is also other details as well, because we have to know exactly who is actually paying the employee. In other words, we have to have the details for the employer as well, where the employer is situated. In other words, maybe the street address or something that can be used in order to locate the employee. And then when you look on the middle row there, we have the earnings, which is actually telling us or displaying us, telling us more about what the employer or is paying the employee. In this case, we have the amount there that is listed as 27,350. That amount there is the gross. That amount there is the gross income. And then before the amount is given or before the amount is given to the employee, it must be deducted, meaning that there are deductions that we talked about on the previous slides that must be done. Deductions such as the UIF. The UIF, which is normally 1% of the gross income. Deductions such as tax, pension fund, and medical aid. We find that in other payslip there are more deductions than the ones that we have displayed here. But then it will be depending, or it will be different from one payslip to another. And then after the deductions have been made, they will be adding, we can add the total for the deductions, and then we can have a net pay, which is actually the gross minus the total deduction. Then we can get the net pay. The net pay is this amount, or is that amount that is actually paid to the employee's bank account. Now we look at the UIF. What is actually UIF doing? The UIF assists employees who become unemployed As we know, during this year, 2020, we had a pandemic which is called COVID-19. During that pandemic, we have had many people who have lost their jobs due to the fact that some of the companies could not operate during that time. So as a result, now companies decided to retrench the workers. And as they are retrenching the workers still need to live even though they are not working. So during the pandemic, they were given an offer to say that they can receive the UIF, which is received through the Department of Labor. So one of the reasons that we have the UIF is for when an employee become unemployed, while the employee is still looking for an alternative employment, the employee needs to work, so the employee needs to receive that amount which is called the UIF. So the employee during the time of employment contributes 1% of the gross to the UIF fund, as well as the employer is also contributing a similar percentage, which is also 1% of the employee's gross. Now, we also have a personal income. Remember, when we looked at the salary advice, we had other deductions. We had the UIF and we had the tax. Tax sometimes is called the personal tax income, or sometimes they call it the payee or the pay as you earn. So we can look at the vocabulary quickly on the personal tax income. There is a taxable income. This is the amount that is used to calculate the income tax due by an individual. So normally the taxable income, they are actually looking at the income that an employee receives per annum or per year. We have also the tax rebate. Now the tax rebate is the money that is being paid. Normally is the money that is paid back to an individual or a business where more than required amount was paid. Sometimes I will advise the student to see the tax rebate as a discount, to say that maybe you have paid more than what you are supposed to pay, then they will give you the discount. Imagine a scenario where you are paying somebody that you owed 50 rands, and then the person says to you, no, instead of paying me 50 rands, let me give you a discount, pay me 40 rand and then take 10 rand back. So the tax rebate is something that is almost similar like that, which is a discount. Then there is also a payee, which is a pay as you earn. A payee is deducted from the employee's salary, as we have seen on that slide where I was talking about the salary advice, that there is a tax there. Tax, I have mentioned that it is also known as a payee. So that is the amount that is deducted from the employee's salary. We also have a non-taxable deduction. These are including pension funds, amongst others, and charity contribution for the businesses. You can also note that each year in South Africa, the Minister of Finance will be issuing a tax form on a year-to-year basis, meaning that the tax form for 2018-2019 financial year is different from the one that we are having now, which is 2019-2020 financial year. Now, this is how a tax form looks like. This is a typical example of a tax form. So when you look at a tax form, first there, it is written there at the top that it is income tax, individual and trust. Then there is a year of assessment. In this case, in our example here, the year of assessment is 28 February 2014, meaning that this is actually a tax form that was issuing between 2013-2014 financial year. On a tax form, you will notice that you have a column there that I will be calling it, or a table there that I will be calling it a tax bracket. A tax bracket, this is the formula, or this is how they are calculating the annual income, meaning that this is how they are calculating the tax based on that tax bracket. You can see that on the tax bracket, on the first row there, you have 0 to 65, which is the taxable income. And then you have the rate there, which is the rate of tax, the rate at which, at how they are calculating the tax. Should it happen that you are earning per annum an amount of between 0 and 165,000 rand and 600 rand. So the tax rate there, it is 18% of the taxable income. We'll speak more about that at a later stage. And then when you look at the next one, you have 165, a person who is earning 165,601 per annum to 258,750. So these are a group of individuals that are taxed to 29,808 plus 25% of the taxable income above 165,600. So at a later stage, we'll go back and look at the tax bracket, at how do we actually use the tax bracket to calculate how much tax are you supposed to pay as an individual. Then when you look at the next table there, or look at the next row there, you have your tax rebates. So I have mentioned earlier that the tax rebate, I normally say to students, you should think of a tax rebate as a discount, to say that you may have paid more than what you are supposed to pay, and then you are given a discount. So there are three types of rebates there that you can see on a tax form. We have a primary rebate, we have a secondary rebate that is enjoyed by people who are having ages of 65 years and older. We have a tertiary rebate that is enjoyed by persons who are 75 years and older. Now, if you look at a rebate, the primary rebate, all of us who are taxpayers are eligible for a primary rebate. In this one, in this tax form of 2014, the primary rebate was 12,080 rands. But when you look at the tax form probably of 2019, 2020 financial year, you may notice that the primary rebate now is no longer 12,080 rands. The secondary rebate is enjoyed by a person who is older than 65 years or 65 years. Let me make an example. Suppose you are a taxpayer who is maybe 69 years old. When they give you a discount using these rebates, they will first give you a discount using the primary rebate, meaning that the first thing you are going to get the primary rebate, then you get the secondary rebate. Now, sometimes the student will know, sometimes the student do make a mistake there and there of saying that when the person is older than 65 years, when they are now subtracting the rebate, they only concentrate on the secondary rebate, forgetting to subtract the primary rebate as well. Remember, all of us, regardless of the age, we are eligible to get a primary rebate. And the tertiary rebate is enjoyed by people who are 75 years of age or older than that. So if you are a citizen paying a tax and you are maybe, let's say, 80 years of age. So when they are calculating, or when they are subtracting the rebate from what you are supposed to pay, they are first going to subtract the primary rebate, and then they subtract the secondary rebate, and lastly they subtract the tertiary rebate. Meaning that if you are a person of older than 75 years, you are also eligible for a primary rebate as well as the secondary rebate before you are given a tertiary rebate. Then if you look at the next row there, you will see that there is a tax threshold. By definition, they say a tax threshold is the amount of income below which you do not pay any income tax. So as you know, all of us are supposed to pay tax, but there are those who are being paid less than the others, That is why sometimes when they are talking about tax, they use the word payee, which is pay as you earn, because they look at how much you are earning and then they will be charging tax based on that amount that you are earning. So when we look at the tax threshold now, we have age, which is playing a very critical role there. For anyone who is below the age of 65 years, the tax threshold is 67,000. For this tax form of 2014, it was 67,111. So what does this thing mean? It means that if perhaps you are a citizen and you are earning, suppose 60,100 per annum, you are not going to be paid, you are not going to pay tax, because according to the threshold here, the threshold does not allow you to pay tax, because the threshold here is saying that anyone who's supposed to pay tax is the person who's earning more than 67,111 per annum or per year. If you are of the age 65 years to 75 years, if you are between those two ages, then your tax your threshold in this tax form is 104,611. And then if you are older than 75 years now, your threshold is 117,111. It's very important that we take note of a threshold, because because with a threshold, you cannot pay tax if you are earning less than the threshold that is listed there on the tax form. Now, let's look at an example here, which I will call it example number 1. Prince has a taxable monthly income of 34,550. He is 47 years old. His monthly payee is 7,549 and 63 cents. Now, the question is his tax calculated correctly? If not, what should it be? Show all your calculations. Now, it is very important here, before we go to a solution, to take note of some few facts. The first fact that we need to take note is that what is given to us here is a monthly income. Remember that I said earlier that we cannot calculate tax using a monthly income, but a tax is calculated using a yearly income or an annual income. So, which means that now we need to make sure that first we convert, or we make that monthly income of 34,550 to be a yearly income. So to do that, remember that a year has got 12 months. So meaning that this guy is getting 34,550 for 12 months. So in order for us to know how much income does he get per annum, we need to multiply that 34,550 by a 12. And when we multiply that by a 12, we get 414,600. Now that we have 414,600, we need now to go back and check on which tax bracket does 414,600 fall onto. Now, if you look at our tax form there of 2014 February, you can see that this amount is falling on the bracket that is between 358,111 to 500,940, which means that now this guy is going to be taxed using the formula 82,904 plus 35% of the taxable income above 38,110. Now, which means that this is the formula that I'm talking about, that this guy is going to be taxed using the bracket 82,904 plus 35% of the taxable income that is more than or greater than 358,110. So, which means that if we continue with the formula, elaborate further, it's going to be 82,904 plus 35%. Remember, 35% is 35 over 100 because a percentage is a number with a denominator of 100. So it will be 35% multiplied by a taxable income greater than 358,110. We can get it by getting the difference between 400 and 14,000, what the person is earning per annum, subtract that 358,110. So then you can see that this will be 82,904 plus 35,000, plus 35% of 56,490. That is a taxable income that is greater than 358,110. So you can see that now the person is gonna be paying that 82,904 plus 19,751. One might think that this is a huge money to pay, but remember earlier that when you are taxed, you also enjoy what is known as a rebate. So if you add 82,904 and 19,771,5, you get 102,675,5. But then you also have to be given a discount. Remember, rebates. That's what we said earlier, that everyone must enjoy the rebates. So think of it as a discount. So this guy has been given a discount of 12,080 rand. So why are we saying he must get a discount of 12,080 rand? Because when you look at his age, he's 47 years old, meaning that he qualifies only for a primary rebate because of his age, that he's 47 years old. That is why we are giving him only a primary rebate of 12,080. And when you subtract the two, you get 90,595 and 50. This is what he must pay per annum, not per month, but per annum. So to get it per month, remember that I said the year has 12 months. So we need to divide what he must pay per annum by 12 to get what he must pay per month, or what must be deducted on his salary per month. So if we divide by 12, 90,595,5, you can see that you have 7,549 and 63 cents. So which means indeed the question that was saying his monthly income or his monthly pay is 7,549 and 63 cents was indeed calculated correctly. So by our calculations there. Now, I hope you understood our first example, because there was a lot there that we had to take in. But then we can also look at the second example. The second example is saying Mr. Mabasa is 49 years old and earns a gross taxable income amount of 350,000 during the 2018-2019 tax year. So the first question there is, how much tax will Mr. Mabasa pay per month? They are saying we have to refer to the tax table above. Okay. One, we need to note that the age of Mr. Mabasa, remember why are we noting the age of Mr. Mabasa? Is because of the tax rebate. So that when we are discounting Mr. Mabasa, we can know exactly which rebate does Mr. Mabasa qualifies for. Maybe is it the primary or is it the primary and the secondary, or is it the primary, the secondary, and the tertiary? But unfortunately for Mr. Mabasa, he is only 49 years old, meaning that he can only qualify for a primary rebate. Now, one other fact that we also need to look at is that of his taxable income. The taxable income is 350,000 per annum. They are saying here during the 2018-2019 tax year. So meaning that during the 2018-2019, Mr. Mabasa received 350,000 rand. So for this one, we are happy because we are not going to multiply anything by 12 because already the income here is given as the income per year. Now, the first question that is there is how much will Mr. Mabasa pay per month? They are saying we have to refer to the tax table. Let us use the previous tax table of 2014, even though they are saying that it is 2018-2019. But let us use this one of 2014 to see how much Mr. Mabasa is going to be paying for his tax. Now, let's look at the solution. So as I have mentioned that in this example, we are lucky because our income is been given per year, which is 250,000. So we are not multiplying anything. Remember, if the income has been given per month, you need to multiply that income by 12 so that it will match the income per year so that we can be able to take that income and compare it with the appropriate tax bracket. So the income here is 350,000. I have already checked on that tax form that we have of 2014, and I've seen that the tax bracket here is actually 53,096 plus 30% of the taxable income above 258,750. So that is the tax bracket for Mr. Mabasa. So when we are doing the calculations, you can see that when we are doing the calculation, you can see that we have 53,096 plus 30%, which is 30 over 100. Remember, a 30% is a 30 over 100 of the taxable income above. A taxable income above 258,750 will be 350. It is advisable that you take the income that you have been given, subtract that income that is there on the tax bracket reflected as above that income, which is 258,750. Then if you see that the difference there is 91,250, and then when you add the two, you will see that when you find the 30% of 91,250, you will see that it is 27,375. Add it with 53,096. Then you will have your 80,471. Remember, people, we have the rebate. Remember, I talked about the age of Mr. Mabasa, which was 47, so he only qualifies for the primary rebate. That is why we are only subtracting 12,080 from what he was supposed to pay as a discount. So in the end, Mr. Mabasa per annum is expected to pay 68,391, and then per month we can divide that amount by 12 so that we get 5,699 and 25 cents per month. That is how much per month Mr. Mabasa can expect to pay. All right. If we look quickly at 1.2, they are saying the UIF is 1% of the gross income, as I've mentioned earlier, and the pension fund is 7.5% of the gross income. So now they want us to calculate the monthly contribution towards the UIF, the monthly contribution, people. And then if we look at the monthly contribution of the UIF, it is very simple. You just say the UIF is 1% of the gross, which is 1 over 100 multiplied by the gross. The gross is 250,000, which will amount to 3,500. Now, this 3,500 is not the monthly contribution, but it is the yearly contribution. So to get the monthly contribution, you can divide that 3,500 by a 12. So if we look at the pension fund, it is the 7.5%, it's given as 7.5 for the formula. So 7.5% of 350,000 is 26,250. This is the yearly contribution, people. So in order for you to get the monthly contribution, you can divide that by 26, you can divide that by a 12. Okay, so don't forget to visit the Department of Higher Education website for previous question paper for you to do more practice on this question, because this question is very important. It carries a lot of marks, sometimes 10 or 12 marks at most. So I hope you have enjoyed our lesson for today. Hope to see you again maybe next time. Goodbye.